We've seen a seismic shift in the credit markets over the past 12 months. Credit markets in Europe have tended to trade slightly wider than the US equivalent. And that's based on there's been conflict on the doorstep of Europe, we had a gas crisis, and generally the macro environment felt a bit heavier in Europe than it did in the US. But if you dig a level deeper, you find that many of the capital structures in Europe have senior secured high yield bonds instead of unsecured. And again, if you look at specific names that might be well positioned for a potential recession, you had a bit of a baby being thrown out with a bathwater dynamic where all of Europe was trading wider and certain names didn't really warrant that. We've had an office in London for decades now, and that allows us to understand the different nuances of the different European markets. Investing in credit in Spain is different than investing in credit in Germany, for example. There's different insolvency laws, there's different capital market participants, you need different relationships. And so we feel like having a presence here and having been here for so long provides a real edge. Every investment that we have in the portfolio goes through a rigorous underwriting process, and that involves many things. It means analyzing the company itself, its cash flows, underwriting the industry, underwriting the legal documentation and the capital structure. It means collaborating with our colleagues on the equities and convertible arbitrage and real estate teams to compare notes and to share ideas across the organization. Through this process, certain themes do tend to emerge. But one of the themes that has emerged is companies that are, we call them hard to value assets, or companies that normally don't screen very well on traditional credit metrics. This may be companies that are free cash flow negative or that have high debt to EBITDA ratios or some other metric that means that traditional credit investors might not like them. As an example, a transaction that we recently participated in involved a Northern European healthcare company. We spent a lot of time, especially with our colleagues in the US, who are healthcare experts, to underwrite this company's drug portfolio. And through a rigorous process, we got a lot of conviction that the company was on its path to monetizing this portfolio. Since then, the company has achieved a listing and our thesis has been validated. We invest using what we call the unconstrained approach to credit, which means that we cover everything from investment grade to deep distress liquidations. And as the cycle moves and as we see the opportunity set change, we can adapt our investment style and our portfolio to what we think is most attractive.